Hello and welcome to the DIY Investing YouTube channel. We are going through every company in the S&P 500, and today is American Electric Power Company, ticker AEP. And in the next 5 minutes, I will discuss both my valuation for the company and what I think of the business quality. First thing we need to understand is industry, and that is the electric utility industry. These are pretty much understandable, but it's important to know what types they're involved with. And here we see both generation, transmission, and distribution of electricity for sale in the United States. That basically covers it. Lets us know that they're in multiple areas, including coal, lignite, natural gas, nuclear, and hydroelectric, as well as solar and wind. So they basically are in all different areas and not necessarily exposed to one more than the other. Beta of 0.3461 is significant because as an S&P 500 company, I expect this number to be closer to 1. The fact that it's at 0.3461 suggests that it's a relatively low volatility company, normally suggests relatively high quality. Share turnover 149, not really significant for an S&P 500 company. Return on invested capital. First thing I like to see is that they've only lost money in 1 year out of the last 20. That's a good sign. What's a bad sign is they can clearly never get more than 5% return on invested capital. As an investor, this alone should discourage you from buying the stock, because what it means is that you're never going to get a long-term return in the stock exceeding their return on invested capital, except if they could leverage it up with debt to get a higher return on equity. And as we can see over here, they can, over the last 10 years, leverage that to about a 10% return on equity, which means that the max return you should expect holding the stock for the long term is 10%, while the minimum is going to be, could be very different than that. And so the only way that this even works and that they've been able to leverage it like that for so long is because interest rates are so low. If interest rates were higher, you would expect return on equity to be lower because they'd be paying more interest. So I'm not excited here, but at the right valuation, this could still be attractive for a flip or some various things. With the PE of 17.8, I become concerned though, because you have a price to book of 1.9. Well, if you think about what it means is at a price to book of 1, then your return on invested capital is going to equal the return to the shareholders and debt holders. And so you really need to pay a price to book of 1 in order to get a return on equity of 10% for you as a shareholder. The fact that you're paying almost double book means that your return is closer to 5%. And so as a 5% return is simply too low for me to get interested in a business, especially when there's many other options out there. Margins are basically irrelevant because the profits that they can receive is set by regulations. You can see revenue is basically flat. So not only are you paying a high price, but you're not getting any growth, and that's not a good sign. You're basically going to just get the dividend. So if we look at the dividend of 2.84, compare that to your market cap, you're paying a very huge price for this company. Your dividend yield is less than 5%. Your return as an investor is likely to be less than 5%. So let's prove out a few things here. We need to look at shares diluted. So they're not buying back shares, which is one concern because that would be one way they could boost the growth in earnings per share over time. So the shares outstanding has grown over time. That's a negative. I would find that discouraging as a shareholder. Balance sheet. So we can see that they've basically doubled their property, plant, and equipment over time from 35 million to, million? No, 35 billion to 65 billion. Not fully doubling it, but still they're growing assets at a significant pace over that period of time, and they're having to use a lot of debt, which you can see is also doubled from 15 billion to 29 billion. And so if we compare that debt to the overall market cap, you're basically running 29 billion in debt to 42 million in market cap means that you have like 70% debt to equity. That's just a very significant amount of money. So they're paying regular dividends. That's a good sign, but you can see they're also issuing regular debt. So you have some sort of weird Ponzi scheme set up here that basically they can't even justify paying the dividends that you are receiving without constantly increasing the debt. Because they don't have a high enough return on equity, they can't self-fund their growth. And that growth is required in order simply to maintain their obligations as a regulated utility company. So to me, American Electric Power is both a bad quality company because it can't earn a sufficient return on equity without leveraging itself up to 10%. The return on invested capital is simply too low to be investable. And despite all that, the only possible redeeming feature would be a low valuation, but you're still paying a high valuation of 17.8. For a company like this with no growth, your valuation needs to be paying 8 PE or less. So this company needs to drop by something in the range of 60 to 70% in its stock price in order to justify any interest in the company. And even then, if you invested, holding for the long term would likely be a mistake. Thank you for listening to this. Hit that like button and don't forget to subscribe and ring the bell in order to get notifications for future videos. Thank you for listening, and until next time, stop paying fees, start building wealth.